Now, Investec Asset Management predicts that a withdrawal of tax breaks and cuts in US government spending to the tune of approximately $600 billion will come into effect at the end of the year. This will see demand sucked out of the economy, which could see as much as 2 to 4% shaved off the country's GDP growth. For more, Jeremy Gardiner, Director at Investec Asset Management, joins us now. Jeremy, it's always a pleasure having you in the studio. Off air, Vivian and I have been talking about the US fiscal cliff, and I see that is thrown forward to in your commentary. Do you think this is imminent?
Well, something's going to happen. I mean, there's a lot of talk about the fact that they're going to be withdrawing a whole lot of tax breaks, the fact that they're going to be cutting government spending, which they have to do. I mean, they're still spending a lot of money. There's an extra $5 trillion of debt over the last 3.5–4 years in the US to fix the situation, and seemingly not a lot of progress. So they do need to cut back on spending. They do need to take away some of the tax breaks that people have been enjoying. And it's the extent to which that happens that's going to decide how much the economy will be affected. The hope is that you get a situation where negative real interest rates ameliorate or eliminate a lot of the problems that could come from this 400 to 600 billion that gets sucked out of the economy.
I know it's a cliff here, but it requires lemmings to jump over it. I mean, do you really think the US, I know there is a disagreement between the White House, Democratic, and the Senate and the House, etc. But do you really think that the US politicians will actually pull the call on this kind of disaster effective for the economy?
No, I don't think it's going to be a disaster, but what will happen is that they will do something. They're going to have to cut back on spending, and they're going to have to cut back on some of these tax breaks. The extent to which will decide whether or not there's a material impact on the economy. The hope, as I said, is that the negative real interest rates outweigh the impact.
But do you really believe that they have to cut back? I mean, what is the actual pressure to cut back at the moment? They can borrow at nothing. There's a whole party, the Democratic Party, which says the actual issue is not such a big issue at the moment. Do you actually think there is a reason to cut back in the near term?
I think they've got to cut back spending. They've got to, otherwise they just carry on adding more and more.
But they're not going to do so before the election, surely.
No, they won't do so before the election. But elections, I think, are in November.
So the reality is going to hit us.
Something will hit us just
2030.
afterwards. Yeah, they're not going to do anything before elections. But then at some stage, you've got to start cutting back. You can't just keep adding. Yes, there are short-term benefits. They can print money if they want to. But at some stage, they've got to address this debt issue.
In terms of the US and how it's going to impact South Africa, a lot of people must be asking you this question right now. It's a wait and see, really, attitude that we have to adopt to the US, because nobody knows whether Ben Bernanke, Helicopter Ben, and all his money, whether that attitude and that approach is going to work or not. Obviously, everybody's watching that US consumer. But coming back to how it will affect South Africa either way.
Well, I think the US is actually starting to, aside from this potential slowdown that may come from the tax perspective, the US is looking reasonably good. I mean, you're starting to see banks lending again. You're starting to see the housing's definitely through the worst. So some of the macroeconomic numbers starting to pick up nicely. Obviously, the dollar strengthening as well. So that'll mean a weaker rand versus the dollar. But I think what investors sometimes forget is that there's a lot of bad news already in the price. If you look at America, if you look at Europe, and often that is the time when one should actually be investing. You know, Europe, where is Europe going? Certainly it feels better in Europe. Do we have a solution? Not definitely, but feeling a bit better than perhaps where we were 3–4 months ago, where you look like you may still get the imminent collapse.
But in terms of just looking at the US, you said it is looking a bit better, I mean, but the unemployment rate is reasonably high. What I'm arguing is the fact that, elections in the US are so tight at the moment. There's just a 1 or 2% either way. And it's going to take quite a bit of, political fiber, a political moral fiber, let us say, to actually push through what would be effectively quite painful cuts in terms of spending. And remember, a lot of the spending in the US is basically non-discretionary. It's Medicare, it's Social Security, it's defense effectively. So how do you really see that US politicians will be willing to actually cut this spending and increase taxes, especially when right now, as I mentioned, you have very, very low interest rates? The world is willing to lend to the US at rates that are lower than anywhere else in the world. Why would you basically want to cut your spending when you can borrow money for nothing at the moment?
We think that they will. You're going to do something. It depends how much. At the moment, they're speaking a big game, the sort of $400 to $600 billion. That's extreme if they do, but it'll all depend on how the economic recovery is going. As I said, the problems are bigger in Europe, but you ask what the impact would be on South Africa. happy world, happy South Africa. If the world if America and Europe start picking up next year better than expected, start growing a bit, then you're going to find yourself in a situation where we go back to a risk-on situation.
Exactly. We're just buffered by risk-on, risk-off, and that's determined by
it's as simple as that.
The rest of the world.
Yeah. Our own problems, and we do have problems. To a large extent, our future is dependent on how the world sees emerging markets. And we do quite well because we're good out of a bad bunch. Yes, we have problems, but there are a lot of problems in Europe as well.
To that point, we've just spoken to Eugene Huissen from Aura Fund Management, who is concerned about China and the momentum that we're seeing, or rather the lack of momentum that we're seeing out of that territory. Is it cause for concern in your book right now, or not at all?
Difficult to say. There were a lot of people at the beginning of the year saying that China could even go as low as 3% growth this year. Now, fortunately, that wouldn't even be a hard landing. A hard landing is about 6%. That would be a crash landing. Fortunately, those fears seem unfounded, and it looks like they're going to come through to somewhere between 6.5% and 7.5% growth this year, which would be okay. Chinese numbers are always difficult to quantify. I get people that ask, can you trust the Chinese numbers? And according to Dragonomics, who are probably the best on China, they say, if anything, the Chinese numbers are understated because they only measure the big cities, not the band of cities around them that are growing significantly. Would you agree?
Yes, but I do think you can't trust any country that comes out with GDP numbers a few weeks after the end of the quarter and doesn't revise it ever.
Yeah. But
going back to China here, people always mention the fact China is slowing down, etc. But if you look at China's economy, not only is it large and growing fast, it's growing fast in a way which demands commodities. So, for instance, look at iron ore consumption, it's well beyond, even copper consumption, it's well beyond what the percentage of global GDP is in terms of global demand. If China continues to grow fast but changes the nature of its economy, it focuses more on inward demand, or basically local demand, going more towards the service economy, will we also not see the same effect in regards to our commodity sector by seeing a collapse in commodity demands?
China can manage and do manage their economy quite successfully. I mean, they've got $3 trillion of reserves that they can use on infrastructure programs, that they can use to get demand going if they need to. They are going to change. Their whole model of having the cheapest labor in the world, banning strikes, etc., is changing. People want more money there. So their perfect storm, if for want of a better word, where they could do everything cheaper than the rest of the world, is changing quite significantly. So I think demand for commodities will be there to a lesser or greater degree. But obviously, if they went down to 3%, then everything collapses. But I think that they'll manage it within the 6.5% to 7.5% level, which would see moderate demand continuing.
That's even below the 7.5%, which is the national target level. You're seeing it lower than the 7.5% for the target level. Okay,
sure.
On that point, I know you're a big picture guy, but perhaps we can just have a sectoral focus and put Eugene's argument to you on the retailers. He also threw forward to the fact that the retailers, we can potentially, this is the South African retailers, we can potentially start seeing some earnings downgrades coming out. And if that happens, then we could see quite a dramatic fall in current share prices. Big picture thinking, do you think that the industrials, the retailers are sustainable? Their story is one of continued success?
I'm not that close to the sectors, but I will say that John Bickard, one of my colleagues, wrote a very good article in the Financial Mail last week where he just believes that it's been going on for too long and he can't see this continuing. So difficult for me to say. What would you say?
What do you
Yes, the interesting thing about the retail sector is that one of the sectors may be negatively affected by an upturn in the economy. Upturn in the economy, interest rates go higher, disposable income may be suffering, and some of the retailers out there that we've been seeing may be negatively affected if we do have an upturn in the economy, certain of them anyway. But my question is this, I mean, the major demand for the retailers right now is not local, it's foreigners. We've seen dramatic shifts in terms of ownership from local to foreigners over the last few years. They are focusing on Africa. What is your view on Africa? Is it a long-term story? Are South African retailers going to be the beachhead in which other parts of the world are going to go into Africa, or are we going to get our our hands or head sanitizers or whatever you may say to buy the foreigners entering that market? I mean, I know you don't look at it.
And perhaps again, because you travel extensively, you can give us what kind of approaches do you get, the level of interest in the African story?
There's enormous interest in Africa. I mean, we've seen all the figures that say from 2000 to 2010, 6 of the world's top 10 economies were African, 7 out of 10 going forward. to 2015. And I think it is the opportunity for South Africans. That is our competitive advantage, Africa. We understand Africa. We understand emerging markets. You see how well South African breweries has done by sticking to that model. And I think a lot of retailers back in 1998, or a lot of companies, when Trevor Manuel led companies take money out of the country, went to Australia, America, Britain and Europe, and a lot of them came back with their tails between their legs. And now you see going into Africa, we understand Africa better than the foreigners. I've never been to a lot of parts of Africa to do business, but I suspect I could fly there and I'd know roughly how to operate, as opposed to someone from Ottawa or New York who would be absolutely terrified and wouldn't know where to start.